Have you ever wondered why some people work their entire lives and barely scrape by, while others seem to build wealth effortlessly? Here's the truth nobody wants to hear. It's not about how hard you work, it's about where you put your money. My name is Andrew Meet Rich, and I used to be completely broke. I'm talking credit card debt, overdraft fees, avoiding bank statements like they were court summons. I thought investing was for rich people, so I just kept spending. New phone? Sure. Designer sneakers? Why not? I was basically lighting my future on fire and calling it living. Then one day I hit rock bottom. I couldn't even afford groceries without borrowing from a friend. That's when I realized I wasn't poor because I didn't make enough. I was poor because I had no idea what real assets even were. I was throwing money at things that made me look successful while staying broke. So I spent years learning the hard way. I studied the data, I tracked the returns, I made mistakes, and slowly I rebuilt everything. Not just my bank account, but my entire understanding of how money actually works. Today, I'm going to show you exactly what I learned. We're ranking the most common assets people invest in, from total disasters to absolute wealth machines. Some will destroy your money, some will grow it slowly, and a few, if you can access them, will change your life completely. Even if today's topic doesn't feel super relevant right now, I promise the next one could be exactly what you need. So hit that like button, subscribe, and let's dive in. Let me tell you about my cousin Danny. Smart guy. Works in IT. Makes decent money. A few years ago, he came to me all excited. He said, "Andrew, I finally figured it out. I'm gonna get rich." I asked him how. He pulls out his phone and shows me his lottery tickets. Not one, not two. 15 tickets every single week. He was spending over $1,000 a year on this stuff, and he genuinely believed it was his retirement plan. I didn't want to crush him, but I had to say something. I pulled up the numbers. The odds of winning a major lottery jackpot, 1 in 300 million. You're literally more likely to get struck by lightning, twice, in the same month. He looked at me like I was the crazy one. He said, "But someone's got to win, right?" And that's when it hit me. Danny wasn't investing, he was gambling. And worse, he thought he was being smart about his future. He wasn't building wealth. He was paying a tax on hope. Here's what nobody tells you. The biggest financial trap isn't just losing money. It's confusing spending with investing. It's buying things that feel like assets, but are actually liabilities in disguise. And here's where most people get stuck. They think assets are complicated. They think you need a finance degree or a trust fund to understand them. But the truth is way simpler than that. You just need to know what actually makes money and what quietly drains it. Let's start at the bottom. The absolute worst places you can put your money. I call these the F-tier assets, the financial traps. Lotteries and gambling are at the top of this disaster list. Americans throw away over $100 billion a year on lottery tickets. That's billion with a B. The average person wastes more than $1,000 annually chasing jackpots they'll never see. Your money just vanishes. Then there's luxury consumer goods, cars, watches, jewelry, designer clothes, the latest phone bought on credit. Listen, I'm not here to judge what makes you happy, but let's be honest, these are not assets. They're liabilities. A brand new sports car loses half its value in 5 years. Warren Buffett himself said cars are the worst investments you can make if you actually care about returns. And don't even get me started on collectibles bought without expertise. Remember Beanie Babies in the 90s? Everyone thought they'd be worth a fortune. Now they're in storage bins gathering dust. Same thing happened with NFTs in 2021. Hype convinced beginners they found a shortcut to wealth. Most of them got crushed. Here's what all these traps have in common. They confuse consumption with investment. They feel good emotionally, but financially, they're poison. Real assets produce cash flow or grow in value over time. These F-tier traps do neither. They just drain your wealth while tricking you into thinking you're playing the game. Imagine putting $100,000 here. In the lottery, it's gone. In luxury goods, it's cut in half within years. In speculative collectibles, it just sits there with no buyer in sight. Now, let's move up slightly. D-tier assets. These aren't total disasters, but they're fragile. They might work under perfect conditions, but most of the time, they disappoint. Take gold and silver, for example. People call them safe havens. And sure, during crises like 2008, gold spiked 25% in a year. Sounds great, right? But zoom out. Over the past 50 years, gold's average annual return is only 7 to 8%. That's barely above inflation and way less than stocks. Gold doesn't generate cash flow. It just sits there looking shiny. Then there's single rental properties. On paper, it sounds perfect. Buy a house, rent it out, let tenants pay your mortgage. In reality, It's messy, vacancy risks, property taxes, maintenance costs, rising interest rates. All of it can flip your math from profit to loss overnight. Small landlords who own just one property face the highest default and vacancy risks. Without scale, rental real estate becomes fragile and stressful. Here's the problem with D tier. These assets depend on perfect timing and avoiding bad luck, and life doesn't work that way. Your $100,000 in D tier won't vanish instantly like it does in F tier, but it stagnates. It bleeds slowly. And that's not the goal. The goal isn't just to maintain your wealth. The goal is to grow it consistently over time. And to do that, you need to understand what actually works, not just what sounds good on paper or what some influencer hyped up last week. Now we're at C tier. Average assets. Not scams, not traps, but also not exciting. They keep up with inflation, sometimes deliver steady returns, but they rarely accelerate anyone toward real financial independence. Bonds are the clearest example. US Treasury bonds are super safe, which is why retirees love them. But safety doesn't equal growth. Over the past 30 years, 10-year Treasuries returned about 4 to 5% annually. Compare that to over 10% for the S&P 500. Bonds protect wealth, but they don't multiply it. It's like parking your money in a garage. Safe, but going nowhere. Then there's REITs, real estate investment trusts. They give you exposure to property markets without managing tenants or buying buildings yourself. Sounds convenient, right? And they pay decent dividends. But they're extremely sensitive to interest rates. In 2022, when the Federal Reserve hiked rates aggressively, REITs lost over 25%. Over the long run, they underperform broad stock indexes while carrying more volatility. And finally, collectibles with expertise. Art, vintage cars, rare watches. Unlike the junk in F tier, these markets are real. Fortunes have been made by savvy collectors, but here's the catch. Liquidity. Selling a Picasso or a Rolex at the right price can take months, even years. Unless you already have the network, these investments often end up as expensive decorations, not cash machines. C-tier assets are fine. They won't ruin you, but they won't make you rich either. They're best used as diversification tools, things you sprinkle into a portfolio to smooth out risk, but they're not the engines of wealth creation. Now we're getting somewhere. B-tier assets. This is where real wealth building starts to feel reliable. These aren't flashy. They don't require insider connections. Millions of people have used them to climb into financial independence. They compound steadily. They're proven, and they're accessible. Index funds are the cornerstone here. A simple S&P 500 index fund has returned about 10% annually since its inception. If you invested $10,000 in 1980, you'd have over $900,000 today without lifting a finger. No stock picking, no guessing, no stress. Legendary investor Jack Bogle built Vanguard on this exact principle. Stop trying to be clever and just ride the market. Then there's dividend-paying stocks. Companies like Johnson & Johnson, Coca-Cola, Procter & Gamble. They've raised dividends for decades. The S&P 500 dividend aristocrats, firms that have increased payouts for 25-plus years, historically outperform the market with lower volatility. You literally get paid just for owning them. The downside? Growth. High dividend payers often grow more slowly than companies like Amazon or Google that reinvest everything. And finally, real estate portfolios at scale. A single rental can be shaky, but once you own 5 to 10 properties, the risk spreads out. Vacancies and problem tenants become manageable. Real estate starts to feel like a system. Done right, it's steady cash flow and long-term appreciation. The challenge is management. Even with property managers, real estate demands more involvement than buying index funds. What happens if you put $100,000 into B tier? That money goes to work. Now we're at A tier. This is where the wealth game changes completely. These assets have the potential to generate serious wealth, but they're not beginner-friendly. They demand capital, skill, or patience. But if you can clear those hurdles, they reward you far more than anything we've talked about so far. Private equity and venture capital dominate a tier. Historically, private equity funds have returned 12 to 15% annually, consistently beating public markets. But here's the catch. These funds usually require at least $250,000 to get in, and your money's locked away for 7 to 10 years. You also need the right network to even hear about them. It's not that they don't work, it's that most people can't access them. Then there are franchises. The model itself is rock solid. You're buying into a proven brand with marketing systems and customers already built in. Top franchises like Chick-fil-A, McDonald's, Domino's can generate six figures in profit per location. Operators average $80,000 to $100,000 in annual profit, but opening one can cost anywhere from $500,000 to over $1 million. And not everyone gets approved by corporate. Finally, commercial real estate. While single-family rentals can be shaky, commercial property, multifamily apartments, office buildings, shopping centers, they scale income in ways small landlords can't. U.S. commercial real estate has averaged about 9% annual returns over the past 25 years, but even a modest multifamily property might cost $1 to $5 million, and lenders expect serious equity up front. Here's the pattern. Tier assets are proven wealth machines that demand serious buy-in. And finally, we've reached S tier, the crown jewels of wealth building. These combine growth, leverage, and scalability in ways lower-tier assets could never touch. At the very top sits owning your own business. According to the U.S. Census Bureau, over 70% of millionaires are entrepreneurs. A profitable business pays you twice, first through steady cash flow and later when you sell it for a multiple of earnings. Imagine a small company making $500,000 in profit per year. It might sell for $2 to $5 million depending on growth. No stock or bond could ever deliver that kind of upside. Next is equity in high-growth companies, startup founders, early employees, angel investors who get in early on the next Tesla, Amazon, Nvidia. They see life-changing returns. A $10,000 investment in Amazon's 1997 IPO would be worth over $1.6 million today. These are rare hits, but when they land, they build generational wealth. And then there's scalable digital assets. The creator economy was valued at over $100 billion in 2022. Top creators earn millions annually. A YouTube channel, an online course, a digital product. Once it's built, it scales infinitely without proportional effort. Here's what S tier has in common. Leverage. Money, technology, or people work for you, not the other way around. Unlike lower-tier assets that depend on slow compounding or personal labor, S-tier assets multiply because they scale far beyond your individual effort. For most people, smart investing is just putting money into steady, proven assets that compound over time. Look, I'm not going to sugarcoat this. Most people will never touch S-tier assets, not because they're not smart enough, but because they're still trapped in F-tier thinking. They're still chasing lotteries, buying liabilities, confusing spending with investing. But here's the good news. You don't need S-tier to build wealth. You just need to avoid the traps at the bottom and commit to the proven assets in the middle. Index funds, dividend stocks, real estate done right. That's it. Consistency, patience, and discipline will take you further than 90% of people ever get. When I was broke, I thought wealth was for other people. People who were born lucky, people who knew secrets I didn't. But the truth is way simpler. Wealth is just the result of putting your money in places that grow and keeping it out of places that drain. You don't need a finance degree. You don't need a trust fund. You just need to stop gambling with your future and start building it intentionally. So here's my challenge for you. Take a hard look at where your money is right now. Is it sitting in F tier, bleeding in D tier, or is it actually working for you in B tier and above? Because the difference between those tiers isn't luck. It's choice. Small shifts lead to massive change. You don't need to do everything perfectly. You just need to start doing something differently. And the best time to start? Right now. Not tomorrow. Not next month. Today. Now go build something real.